And good afternoon. Welcome into Market Talk for Friday, November 13th, 2020. I am your host, Jesse Allen. Find us online, markettalkag.com, on Facebook, Twitter, Instagram as well. It's all at Market Talk Ag. Friday, wrapping up a trading week. We had that WASDE report earlier this week that shot the market higher, a little bit of a down day on Thursday, but grains for the most part looking fairly decent here on a Friday afternoon. Let's bring in our guest analyst here this week. Mike Zuzolo with Global Commodity Analytics is on. Mike, how are you today?
Doing great, Jesse. Thanks for having me back.
Yeah, I appreciate you being on with us here on a Friday afternoon, Mike. And let's dive right in and take a look at this marketplace. Fairly quiet day in the trade. I know yesterday we were down throughout all commodities, including especially the corn market kind of pulled everything down, and soybeans as well. Today, though, looking a little bit of strength here to wrap up the work week. And I'm sure a lot of producers, a lot of commodity folks happy to see that.
I certainly was as well, especially when it came to how we finished the week up with the wheat market. That was the one that really was looking very stressed and projecting some key sell signals in the soft red wheat futures going into Thursday's close with a brand new monthly low and a break below the trend line, the support that's drawn off the weekly and monthly charts from this last 4 or 5 month rally. So it was a critical end of the week for the wheat market. Fortunately, the drier weather for the wheat plains here in the United States, as well as a big portion of Russia's wheat belt and Ukraine's wheat belt, look very dry the next 14 days, with I think both areas going to see that crop go into dormancy with some colder weather, Jesse. So the hard red wheat, actually, if you look at the percent gainers on the day, hard red wheat was by far the winner on Friday. I think that shores us up going into next week. And as you said, that USDA crop report cutting the ending stocks for corn and beans, very healthy, should keep us in a good uptrend as long as that wheat stays strong next week. Because one of the things we keep seeing week after week almost, and especially after a USDA report, is the beans try and go higher, but if they don't have corn and wheat going higher with them, it just doesn't want to go, and it starts to see some profit taking. And as you said, we saw a big down day on Thursday led by corn. I think that was the funds, and that was triggered by the wheat break to the downside because that corn and that wheat market's so sensitive, and that kind of left the beans standing all by themselves with no support, and they too then joined the party as far as the downside. So nice way to end the week with the wheat futures having some support and that monthly chart support in the soft red holding firm.
Yeah, great point there. You mentioned, with the wheat obviously supporting this market yesterday, it seemed like, yeah, a little bit of taking some of that risk away. Some of those funds were getting a little bit of profit taking in there. But again, today, wheat percentage gainers led things. Beans up modestly, though. We're toying with that 1150 mark after we had a little bit of a reversal yesterday. So, I mean, looking at soybeans, are you seeing some resistance here? I know some folks after that WASDE came out earlier this week saying, $12 beans on the board's not out of question. What are you thinking with this soybean market, Mike?
I can accept the 1160, 1170 level, Jesse, because that's kind of the highs from back in 2016 that we got to. I believe it was in August or July, somewhere around there. The $13 bowls are the ones that I'm really disagreeing with right now, especially if we don't kick it in the butt with the wheat market and we don't stay really dry in South America. If I was going to see $13 beans, I would project that more like a December, January time period where we actually knew we were cutting the crop production substantially for Brazil. Right now, the USDA is at 133 in terms of million metric ton production. CONAB is probably around 136, if I remember right. And, I'm right in there in that 132, 134 area right now. 60 days from now, when you and I talk, if we stay dry, I could cut that dramatically and we could be back in the mid 120s, kind of like what we dealt with this past year. Then I can start talking about a tighter global soybean supply demand balance sheet and not just have to rely upon the United States. And that's probably what I think the market's going to have to adjust to here in the not too distant futures. Get away from maybe the U.S. side of the equation and start thinking more globally, because we're not at 850 anymore. And if we're $3 higher, that's probably rationing some demand at this point. And we've probably seen some further purchases that go out farther, especially given this COVID spike, which by the way, this COVID spike is something to really watch. You and I talked about that last week as far as the sensitive commodities, and it's not getting better. It's getting worse with new record highs twice or three times this week in terms of hospitalization numbers. And that's the number I really watch.
Yeah, Mike, and looking at soybeans here, would you say it's probably safe to say that maybe if I'm a producer, get a floor underneath me here with this just because, you know, we don't know if we're going to reach that $12 mark. I mean, obviously, if you can get a floor underneath you and at least find some profit here at these prices, it would seem like a good idea.
Yeah, I can't remember if I said this last week or not, but I've been talking to clients and subscribers about soybeans in particular, putting in a near-term high the month of November. The November 20 beans went off Friday, went off today. They went off at a discount to the January. So now we're back to a carrying charge market, which is not ideal for the bull. We've got January premium to where the November went off. And we noticed the bear spread worked really hard the second part of this week. We're actually going to be up around 1140 plus in the November 21 crop. So I think what you want to do, if we don't see a turnaround by the end of this month and we start to see the technicals give way, then yeah, move on 21 hedges because of the price level we're at now and that premium we can get over $10 in terms of soybeans off the combine in some areas. And then if you're worried about the market going higher, say in December or January, come back in and buy the front end, buy the South American weather. And so do a March or a May bought call. And like you say, take the unlimited risk off the table of what you have in the bin or what you haven't sold yet and replace it with known risk, because this is a time period traditionally where, especially given the seasonality, we don't really like to go much higher as we get into the holidays. And so I think it's natural and it's probably healthy that we pause. So I think where I'm seeing this week, Jesse, versus last week, is there's a lot more bulls coming out of the wall and out of the woodwork, and they weren't there a couple weeks ago, let alone a couple months ago, and that always kind of scares me.
Great things to consider there with the soybean market. On the corn side, you know, we hit that 424 high earlier this week. And then with the pullback, you know, we're having a little trouble reaching that on the December contract. We're at 410 and a half. Looks like here around 410 today. Looking at this corn market and, you know, looking out the next couple contract months, I mean, I think a lot of producers are sitting here wondering, are we going to be able to push this higher? And I think, again, it's like you said earlier, it comes back to probably that wheat market.
Yeah, it does. And it comes back to profit per acre. If you've got a 20 over basis and then you've got July corn or May corn sitting at 4.25, I mean, you're talking about 450. And if you did 225 bushels on your yields this past year, this past fall, why would you turn that down, especially when you can come back in and get a May or July call bought in place of it? The thing about the corn, I think, that distinguishes it from the beans and the wheat is it probably has the least amount to fall because we are the cheapest price at the Gulf of Mexico by far. We're probably $30 to $50 a ton cheaper than all of our competitors, whether Ukraine or Argentina. I think the USDA did a good job of cutting the yield, raising exports. They also cut the Ukrainian exports for corn by 8 million tons. One thing they didn't do was change the Argentine production number, so I think they're still too high on that by about 5 million metric tons. And I noticed on Friday that Turkey, of all countries, put out a tender for 350,000 tons of corn, and they wanted the offers to be closed in terms of the offers put out to be done by November 24th. So that's almost a very quick ship type mindset to want to close the offers out that quickly. This is very odd because I think it suggests that we do have a really tight supply situation globally in the corn. So beans and corn are almost the exact opposite. You have a very tight global corn supply, but you have still a decent U.S. supply of corn, not burdensome and not super tight, decent supply. So I think corn, simply put, for me, Jesse, is the best one to buy back if you make sales. It's probably the one that has the least amount of downside unless we start to see this feed sector get hurt or the ethanol sector get hurt from COVID, which those are two things I'm really on point for right now.
Well, let's talk about that feed sector and let's switch over to livestock here, Mike. I know a down day across the board in livestock, but specifically cattle. You know, we finally seeing some activity in the countryside, but you talk about feed costs and everything there, and this cattle market trying to kind of push forward, but it's been starting to looks to me falling into kind of a sideways range here. Can you talk about what you're seeing in the cattle market?
Yeah, I think the dressed weights are just too high given this shutdown potential in all these states. I mean, I think that's what happened at the end of the week. I quite frankly was really surprised that the cattle were rallying to the upside. I thought it was probably the equities market rallying and also the hogs keeping them boistered and bolstered up. But I kind of feel like that the cattle really have to be hedged at this point. And I did some hedging in the April fats and the February fats earlier this week with clients and subscribers, sending out text blasts to them to get their first and second quarter hedges in place for half their marketings for those 2 quarters. Keep in mind, USDA's average price for cash steers for the second quarter is 110. April just got done knocking on the door of 119. So talk about an overvalue level if we start to close down a bunch of restaurants. And just as importantly, the institutions are talking about not coming back the second semester in some of these states like Illinois schools, Iowa schools, or if it was Iowa or maybe Ohio schools, but there's a lot of states now talking about maybe not bringing their kids back in the second semester after the holiday break. This is institutional demand that we absolutely have to have, or our cold storage numbers are probably going to start to balloon, and then it becomes a buyer's market instead of a seller's market. So when you have dressed weights as high as we do in the cattle, I just don't want to monkey around if we're $9 higher in futures than what USDA's got for their second quarter price. So cattle are a lot more on high alert to get hedges in place. Hogs, maybe I'm not pushing as hard on the hogs because we've lost quite a bit of premium here this past week. If we would get back up to that $70 range in D's hogs, get back up to where the cash index is essentially, then I'd start looking again for February and April marketings.
Well, on this cattle side, Mike, I'm looking today, seeing some live sales. 110 is kind of the number. Kansas, Nebraska, Texas. Nothing really out there yet on the dress side as of now. We'll see if later this afternoon there's anything there. But this countryside, yeah, it's just kind of quiet. And I'm with you. I think it's time to get some hedges in place in this cattle market if you want to at least lock in some semblance of profitability.
Yeah, and this is where in an individual basis, if you've got your feed needs locked in or you got your own feed covering yourself on your farm, that may give you a little bit more legs to stand on. But I can tell you this week in central Kansas, one of my feed clients sent me a text that said that Milo now in certain parts of Kansas is $1.50 a bushel over corn right now. So how do you make money when your feed costs are skyrocketing like that unless you have a good hay crop or you have corn on your own farm? So you really have to take care of the marketing side of the cattle because you've got two big unknowns, and you could have a market here where the corn keeps going up and the cattle keep going down, and you don't want to get trapped with both ends hitting you like that, because I've seen that in the past, and that is a really easy way and a quick way to dig yourself into a hole you can't get out of.
You mentioned on the hog market, looking to try and maybe get that D's contract back up around 70, where that cash index is, and really, well, this is another market where we kind of just been stuck in a sideways range. It seems, Mike.
Yeah, but the nice thing about the export sales and the demand and this range that we've been in is the export sales are not faltering. I mean, we did another 42,000 metric tons, I believe it was on the
Yep.
port. Yeah, 36% above the 4-week average. That's saying something given what we've been shipping out these last couple months. And so China is still buying with both hands, and Mexico's buying with both hands. So I think that's where the hogs and the corn seem a lot similar, or maybe the beans and the hogs seem a lot similar in terms of the demand side. And it makes sense why the funds have that pork and bean trade. If China's doing well, they tend to buy beans and the hogs together. Maybe that might have been some of the issue earlier this week or during this weekly trade where the hogs were going lower, and some of the bean bulls that typically trend with the hogs were saying, I'm going to stay out and not be long here anymore. I think that's a real key spread to watch as we go forward.
You mentioned ethanol and that factoring into the corn market. I want to talk, ethanol, oil prices, things like that here real quick. Obviously, again, COVID is going to start factoring into a lot of this again with the spikes with everything. And looking at this ethanol market, I think specifically, what are you thinking there? Are we going to see some of that come back maybe around the holidays? Or I would assume COVID's probably going to play a role in kind of keeping a lid on this ethanol market right now.
Yeah, this is a tough market right now when it comes to the energies because I can make different cases for diesel prices, for ethanol prices, for crude oil prices, for unleaded prices. And so it is probably one of the most difficult markets right now to analyze from bearish to bullish in terms of
Mhm.
price. I think crude oil has the most downside, followed by the unleaded, followed by the ethanol. And then the best looking market out there is diesel. I actually had a couple clients in Indiana this week tell me they could get transport loads of about 155, 160 on their diesel. And I said, the thing that I think is going to happen is the refiners are going to continue to slow their refining capacity and their utilization rates are going to be low. So expect the diesel inventories to remain very tight, maybe above the 5-year average, but not to build much, even if we have these COVID spikes. We saw that with the COVID last time too, Jesse, where we saw the truckers were essential workers. They got their hours lifted on how many miles they could drive, how many hours they could be on the road. So I think the diesel is something that's probably friendly if a COVID spike happens. I think that's where it goes back to the unleaded market. If it starts to give way with the crude oil, expect the ethanol market to fall with it. But fortunately, we're still hanging around 3-year lows on ethanol stock. So I don't think it'll be right away that the ethanol drops in price. Plus, the margins are still sitting around 10 to 15 cents a gallon in Iowa, eastern Nebraska, some of the key areas that I watch for the overall Midwest and central part of the United States. So I think ethanol is better insulated than it was this past spring, but the upside will be really, really limited if these COVID spikes have any kind of sustainability. And as you say, the driving for the holiday is just flatline. And that if that unleaded price starts to go down, expect eventually the ethanol to play that into maybe following that trend after a couple, 3 weeks.
Well, Mike, any other final thoughts you have for us today? If I'm a producer here, wrapped up harvest season, what can they do?
I think the big thing is go from unlimited risk to limited risk if we get wetter in South America. The wheat's kind of on its own tangent with the dry bias in Europe and Baltic and here in the United States. But I think a lot of bean bulls out there are weather bulls. Be ready for them to jump if the weather turns here the second half of November.
Mike, if folks want to reach out to you and get a little advice on their marketing at Global Commodity Analytics, what's the best way to do that?
Best way is to sign up for a 2-week free trial, Jesse, globalcomresearch.com, and that's with 2 M's on the global com. Otherwise, call me toll free at 866-471-2588 after the market closes and be happy to talk to you.
Mike, appreciate the time as always. And I know next week we'll get back to our usual Wednesday spot. So
That sounds
thanks
great.
again
You
and
too,
have a
Jesse.
great weekend.
You too. Have a great one, sir.
Mike Zuzolo with Global Commodity Analytics joining us here today on Market Talk. Find us online, markettalkag.com, Facebook, Twitter, Instagram as well. It's all at Market Talk Ag. Our radio partners as well, including KMA in Shenandoah, Iowa. Thanks to them for joining on with us. And many more places you can listen to the program, including Spotify, Apple Podcasts, iHeartRadio, and more. This has been the Friday, November 13th, 2020 edition of Market Talk. I'm your host, Jesse Allen. Have a great afternoon.